You've probably seen the pitch. A trader flashes a luxury car, a high-end lifestyle, and promises that if you just give them your $500, they can turn it into $5,000. It is an incredibly compelling illusion, designed to shatter the moment you actually try to replicate it. Drawn in by these promises, a beginner usually joins a VIP signals group and follows a supposedly secret strategy. For the first few days, it actually works. The account grows, the trader feels like a genius, and the flashy lifestyle suddenly feels entirely within reach. Then comes the inevitable drop. Without warning, a sequence of trades goes entirely wrong. The balance drains rapidly, and within hours, the entire account is sitting at zero. Why did a strategy that worked perfectly yesterday suddenly wipe out an account today? The truth is, the strategy didn't fail. The failure stems entirely from the myth of 100% confirmation. In financial markets, absolute certainty does not exist. No trader on earth wins every time. When someone believes their strategy is flawless, they strip away their own psychological defenses, leaving them completely vulnerable to the absolute certainty of an eventual loss. Any legitimate, long-term trading system will experience back-to-back losses. Taking 2 or 3 hits in a row is a normal, mathematically expected event in the market. This is a probability distribution model showing a typical sequence of wins in blue and losses in red. Professional traders look at a sequence like this and view the red dots not as failures, but as standard business expenses. But a beginner brings a rigid expectation of constant success. When that expectation meets normal statistical variance and they encounter a cluster of losses, their mindset fractures. By the second or third consecutive loss, rational thought gives way to panic. The trader abandons the math of the system entirely. The trading strategy itself remains perfectly valid. It is the human operator whose psychology breaks under the pressure of normal probability. This psychological break often originates from an overconfidence loop. This loop starts forming when a trader hits a rare 7 to 10 day winning streak. Take a look at this chart tracking steady, incremental account growth alongside a trader's risk level. During a winning streak, the trader begins to feel invincible. They alter their risk perception, abandon their money management rules, and heavily over-leverage their account to chase bigger payouts. Then the trigger event occurs. The trader hits their first stop loss in over a week, and because they over-leveraged, the financial hit is severe. A professional accepts the dip and moves on. The overconfident beginner panics. They refuse to accept the loss, gripped by an overwhelming urge to recover the money immediately. This triggers revenge trading. Risk management is completely discarded. The trader begins executing random, erratic positions driven purely by anger and desperation. When the account finally hits zero, it is easy to blame the market or the technical indicators. The reality is an emotional death spiral hijacked the trader's discipline. Think of trading like opening a physical market stall. You would never rent a storefront, stock the shelves, and open the doors without knowing exactly what you are selling or how to run a business. Yet people fund trading accounts every day without understanding the absolute basics. Placing blind faith in online gurus or VIP groups removes your agency. If that guru disappears tomorrow, or if their signals stop working, you are left completely helpless with no underlying skill to rely on. You must build your knowledge from the ground up. You have to understand market mechanics, analysis, and strategy before you commit any significant capital. Most importantly, you must develop the critical habit of a professional, the ability to unemotionally accept a stop loss as a simple cost of doing business. A strategy alone will never make you profitable. Long-term, month-over-month profitability is entirely the result of strict, unwavering discipline.